All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. We are about 15 minutes away from the Fed release here today, and we're looking at a market that is fairly strong going into it, up about 25 points. But 25 points in this market isn't 25 points in a normal market, but is breaking or is pushing to the highs from yesterday that we saw. Yesterday into the close. Even before, when I did my last video, I mentioned we're probably going to have some big moves. We had multiple really big moves here. And you can kind of see what today looks like. I mean, we've had a couple 20-point moves here, but overall, the magnitude of move has been a little bit smaller. The volumes have been pretty good. They've been pretty decent. This is not a low volume move here today. It's a normal type of volume move here on the day, and we're seeing some strength in the banks, some global ETFs with a little bit of strength like the WZ, China ETF lagging here. But this is not a rally being led by consumer staples and utilities. Yes, those are up, but not to the same degree as other things. Materials are pretty strong here, and energy is getting a little bit of a oversold bounce here today. In terms of the dynamics heading into the Fed here, there's not a lot of change, meaning we're not seeing the metrics really shifting in a big way pre-Fed. Sometimes we see it, but not often. And so, very normal to kind of see that, and tells you market conditions are still about the same. We're probably still going to be in for quite a lot of volatility here going forward. All right. Now, before we look at how the Fed or how the market reacts to the Fed, quick comment here on Facebook, and I put my thoughts into the message feed. This morning, Facebook opened up, and it was a report out of the New York Times that they had been sharing more data with bigger companies than what they had let on, and Facebook gapped down because of that. And we can see it trading lower in the pre-market. And then it opened up and went green, went positive, pushed up into this 145 area. It started to fade a little bit. And I was watching this fade, and I was looking at it, I go, okay, you know what? We had a nice little turnaround right here, little decent signal that, okay, that's probably going to be the low for the day, and then it just cascaded and rolled over. What happened? Well, the Washington, D.C. Attorney General filed suit against Facebook over the Cambridge Analytics debacle, and basically, Facebook went on a landslide. You can see the volumes, just monster volumes came into it here on this downward move. And I mentioned, I said, this is one where, just from an exposure standpoint, it kind of wipes out my exposure, so there's no reason not to hold it. And so I'm still in it. We've seen it bounce back here, $4 off of its lows, but still down about $6 here today. Leaves my option about $9 out of the money, and leaves me about $300 worth right here. So it's not nothing there. So I will have to kind of take a look at that as we get a little closer to the close. But this is one where, as I look at it, it's rehashing old stuff, and yes, it's going to, in a market environment like this, it is going to send the stock lower. Is it something that is ultimately going to weigh on it? I don't think so. To everything that I've looked at and know about Facebook and have followed with Facebook, I think the majority of all this Cambridge fallout stuff is priced in. And, it doesn't mean that this move is incorrect or anything like that, but it is one where I wouldn't be surprised to see it be a today, tomorrow type thing, and then still have a decent shot of pushing significantly higher. But that said, the option I'm in, $300 might be better served elsewhere. So I will be taking a look at that here as the day winds down. But I want to see, not just how Facebook reacts, but I want to see how the market itself reacts here to the Fed here. And I don't really care what the Fed says, right? I'm not going to sit here and say, well, if the Fed says this, then this is going to happen. If they say that, then that's going to happen. I think it's a frivolous exercise. I think it's one that, doesn't mount to a heck of a whole lot. But what I do think is important is the market reaction. And one of the things that has happened, with the Fed of late is the reaction to the Fed has changed. It used to be that on a Fed meeting, you would have the market and it would be at a certain level, right? And then the Fed would come out with their stuff. And we'd see either a shot down that would be followed by a shot up, or a shot up that would be followed by a shot down. Either way, we create a reaction high and a reaction low. And then, futures would kind of come back generally to even and chop around a little bit. And then you knew which way the market was going to go by one of these reaction highs or lows getting broken. And if the reaction high was broken, boom, you bought. If the reaction low was broken, you sold, you bought puts, right? That was 2010, 2011, 2012, even 2013. This worked really well. 2014, not so much. 2015, not so much. 2016, 2017, we start to see a change. We start to see this dynamic where the market's at a certain level and it gets a reaction range, right? Sets a reaction range, whether it's first up and first down, but we get a reaction range in the first 30 minutes, right? And then we get some chopping, and then sometimes we'll see that reaction range broken. And it's not, hey, buy puts. A lot of times that's, oh, boom, here we go. We're going to break this reaction range. The overall real reaction range hasn't been created until the last half hour of the market. And so it's taken a lot longer. And then what happens the next day is we see that reaction range get broken. And that's been a pretty good indicator of, at least short-term direction here. And so as I look at the Fed and I look at what goes on, I'll be watching some of the price action, but I suspect we're going to have multiple reactions. And, it is something where it is possible that the Fed could say something and it just sends things higher and higher and they never look back, and vice versa. That is all possible. But it is one where the norm or what has been this kind of heavy reaction range. And so I'm looking to see what that reaction range looks like, how different stocks are reacting. Are we seeing safety flows? And then most importantly, are the market internals changing? Right? Do we see the market internals change today? And so far on this rally that we've seen, this 20-point rally, we haven't seen the market internals change. They haven't changed a lick here today. Most stuff, it's, that was below the 7 is still, and vice versa. 20-day moving averages, same. Bullish percent index, volume flows, highs versus lows, even the key ratios between the different sectors. It's all the same thing. And, we're going into this Fed meeting with the market internals incredibly bearish in an incredibly overbought state, and that hasn't changed by the little bump up that we've seen in the market here today. And it is something that could easily change. But I was asked earlier today, could we see a wow event on the Fed here? And I don't think the Fed will. I don't think we'll see it right away where, boom, here's the Fed, boom, market moves 100 points on the S&P. But I think the Fed could catalyze a wow event over the next couple days here in the market, and could be on both, could be pretty hefty on both sides. I was looking at a few trades kind of leading into this, into the Fed here today, and, some things like some Bank of America. I mentioned that personally I bought some of this earlier this week. Can I play a little bit of call action? And, the reality is the calls are, still incredibly overpriced, and, it is something where, post-Fed here, we probably see these implied volatilities drop dramatically if if it's flat to slightly up. So just the option risk to me is pretty heavy, to do a lotto, and I'm not exactly in a position for the challenge to do a lotto right here. So, really, I need my next trade to be pretty strong. And so I'll wait for, the exact setup that I want. And, if and when I get it, we'll go after it aggressively here. All right. We do see bonds, the TLT, trading back to 120 here ahead of the Fed today. You can see the TLT, this 120 mark. That has been a high water mark here over time. And, you can see this. Here's a weekly chart. You can see that this year that's kind of been the high water mark. And, to see bond yields really kind of, falling, to this degree, and bond prices themselves rising to this degree, I'm sure that's sending a little bit of a signal to the Fed about, hey, be careful, because if they continue to push that front end up, while, here's the 20-year, this 20-year, what's happening to the yield here? It's dropping. And so if they continue to push the front end up and the back end drops, they're in a position where, they are creating more flattening on the yield curve, and, do risk inversion, and we've seen minor inversions here and there. And I'm sure all that will be hotly debated and everything when it comes down to it. But, again, it's one of those things where, it could change pretty quickly here on the Fed minutes. I'm also really curious in the U.S. dollar and how it reacts. I don't think there's something that can be said or done that will, spark a reaction. But we have this rounding action that's kind of happening here in the UUP, in the U.S. dollar here. Just kind of this rounding, and, we see some of the momentum oscillators like the MACD, pushing down as it rounds. Now, the U.S. dollar did this back here in the summer and had this kind of rounding pattern, and same thing on the MACD, and, never really broke down. In fact, broke higher and, ultimately sits higher here again today. But are we going to see a catalyst for a sharper move lower here in the U.S. dollar? As you know, I'm bearish on the U.S. dollar overall, but it is something that really hasn't given any kind of, all right, we're ready to break down type of scenarios here, since kind of July, and that one reversed on some news. And, we've seen the dollar hold strong ever since. So, the Fed could ultimately, catalyze something that, where the Fed, differs here, or where it sparks some sort of move here. All right, so here we are. We're what, 2 minutes here before the Fed? And I just got note that there's a buffering error that came in. Hopefully that is rectified and fixed, and we don't have that anymore. All right, so here we go. Market, you can see jumped about 8 points 2 minutes ago. It's come back a little. It's kind of normal volatility here with the market, with S&P futures. And we'll see what this reaction kind of looks like here in about 30 seconds. I will have the news feed up to kind of see what's being said. But again, I'm not triggering any decision based on anything that's said. And I'm not looking to enter anything or exit anything, while I'm on video here. It is something where, if I do make a trade off screen, I do have my own account up. I'll let you know if I do that, but I won't have time to get something out for the challenge. With how fast things are likely going to move here. All right, so you see initial jump here higher. All right, initial jump here higher, and coming in. That's generally just automated trading. That's not fund managers. That's not decision makers. That's automated based off a keyword, and you can see how quickly that's erased. Right? It's been erased. In fact, immediately. So that's the automated automated sector here, and we do see that really kind of come into play here as the Fed did boost rates. They did raise rates here by 25 basis points, as expected, as telegraphed. So the Fed is kind of continuing to do what they say. And, I do think overall long-term market confidence, that's an important thing. But short-term, the market's going to look at the Fed and go, huh? So, market's going to definitely be looking at Fed Chair Powell this afternoon in about 30 minutes for, hey, come on, give us your logic, because this doesn't make a whole lot of sense. But here we are. We're in the reaction phase, right? And, generally over the first 30 minutes is where you create the reaction range. But, we have seen that be significantly greater. Check out the banks here. You can see the big move in the banks. Even Bank of America, kind of the same thing. I mean, 25.24 down to 24.85 in a matter of minutes. I mean, 2% moves in a matter of minutes here. It's a hefty, but it's not huge. It's not, it's nowhere near anything that's incredibly unusual or different than what is seen from time to time here. If we look at, let's take a look here at the TLT. You can see TLT minor bump up on this. So Fed raised rates, right? Natural logic says bonds should go down. Well, bonds are going up, right? And, that's the market basically saying, look, you're not going to keep raising rates, are you? And I think that's what we're seeing the market kind of say here. But we see bonds slightly up. We see the U.S. dollar slightly up here on this. So coming off of its lows for the day initially here. And, if we compare that to the U.S., the euro versus the dollar, you can see the euro dropping, down to kind of where it was sitting overnight. Here as the dollar itself rises. If we look at various sectors here, the XLP, consumer discretionary, dropping, the XLU dropping, the XLV, which is healthcare, dropping, energy dropping, industrials dropping, financials dropping, right? This is a mass move. This isn't a differential type of move where investors are signaling, oh, well, this happened, so, okay, here. This is, money all in, money all out, and kind of the whole ETF moving things up and down rather than some major differentiation here. And that is a bear market characteristic that, we've seen and, we'll continue to see as long as the market metrics, remain bearish overall. Small caps are pulling back. China is pulling back. Brazil is pulling back. I mean, it's just kind of a mass deflation here initially, right? Initially. And, you can see how that was opposite to the first initial reaction, which is, relatively common, relatively usual out there. Volumes are about normal, for the Fed. We've seen some really light volume Fed releases of late, but this one, back to kind of normal territory where we would expect to see it, given the fact that, the market is just trying to find something to key on. But let's see here. Fed members' lower view on the end 2019 Fed funds rate, 2.9% from 3.1. So basically, the Fed's saying, "Look, we're seeing the economy. We're not seeing the economy as strong, so we're going to lower our views." Federal Reserve information received since the FOMC meeting met in November indicates the labor market has contributed to strengthen. It's such a lagging indicator, this labor market, in that economic activity has been rising at a strong rate. Job gains have been strong on average in recent months, and unemployment rates remain low. Household spending continues to grow strongly, while growth of business fixed investment has moderated from a rapid pace. So, they're not saying anything that, that is different. Yeah. They'll continue to monitor global economic and financial developments and assess the implications. So, they're not saying anything, revolutionary or hugely different. They're kind of keeping their bases covered here. Which is smart by them, and they've basically come in and done what they said and targeted, indicated that what they would do, and they have indicated that they may not be as aggressive here in 2019. So yes, there are going to be microcosms of this that are going to be picked at, that are going to be looked at and go, oh, the Fed's changing here and the Fed's changing there, But when you compare this to what Powell and some of the other Fed members have been saying over the last couple weeks, this is pretty much in line with that, and something where, do they have a lot of wiggle room? I mean, they have some, but nowhere near the wiggle room that they historically have, because generally when we start talking about economic contraction or economic slowdown, the Fed's in a position to be able to cut rates because rates are up at 5, 6, 7%, not down here at 2%, where they're kind of fiddling around with a 0.25% move here. So anyway, that's the statement. Again, we're going to hear from Powell, and can we call this the reaction range here just yet? I don't think so. I don't think so. I don't think it's enough in terms of enough time that has gone by to really look at this and say, the reaction range is in, and, high, low, and all of that. I still think we're in for quite a lot of movement up and coming here with it. If you take a look at this reaction candle down, if you're looking to day trade, right, you look at this reaction candle down, a lot of times after it breaks below this, if it's able to get you a 1 minute candle that closes above this low, generally you start to fill that candle. So if you're looking, you want to day trade some SPY or something like that. That's kind of a little short term setup, a little short term tendency that's in here. So from here, not the initial couple candles, but 5, 6, 7 candles lower. But if it breaks above, where is it at right here? 25.57. Right, and when you see the 1 minute candle close above 25.57, you could generally play a little bit of a move here. 10, 12 points in this case is what I'd be eyeing and what I'd be looking at if that occurs or if that happens. Here just yet. So that's all about you would take from it from a trade standpoint. In terms of this reaction and how things are. You look where it is right now. If this is the reaction range, 25.90 to 25.45, we're basically talking about a 47-point reaction range here. That's not exactly huge, right? That's not exactly a huge range. Is it bigger than most? Absolutely. But given what the current ranges on the market have been, it's not exactly a huge range here just yet. But, lots more to come. Lots more to come here. This is still something where, where we could see some major change here in the next little bit. But you can see the market very quickly has erased the gains for the day and has pushed on into the red as the Fed has once again raised rates as they have told the market that they would do and would continue to do. I find it very interesting. Market selling off, bonds rising, and you see this big push in bonds here. They have continued to rise on this, and that's the back end of the curve, back end of the yield curve dropping. So in essence, what the Fed has done is they have flattened the yield curve here today, and even further. And, you're probably going to start hearing more of that inversion word. I'm not sure how quickly Stock Charts updates their yield curve. I think it's a close. It's a closing thing. So, 17th of December. So, it doesn't have today's. But you can see how, kind of relatively flat the curve is. And the Fed, what have they done? They've pushed the front end up. Right, they've pushed the front end up, and what do we see happening with the back end, especially on this 20-year? We see it dropping. So it's going to be significantly flatter here if it were to close like this than what it has been. So That's the net effect that we're seeing so far. But again, Fed isn't done. Fed isn't done, and they have a lot. I'm sure Powell will have a lot to say here shortly. I'm going to hop off, and I'm going to be listening to Fed Chair's comments and everything. I will hop back on before the market close here today. As I've mentioned, I expect the reaction to kind of take place throughout the rest of the day and even into tomorrow morning. So I'll be kind of taking a look at where things are set up, where some of the risk rewards are, if there's some option elements there that I can look to take advantage of. And if there is, I will definitely go out and do so. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.